Hello and welcome to India Career Center, the one stop podcast for students, professionals, parents, and guardians. In every episode, we will try to deal with a current topic that needs expert advice related to career guidance, and career mentoring. Please welcome your host, Dr. S.P. Mishra, to the show. And happy listening.
Okay, ladies and gentlemen, welcome to another episode on India Career Center. In today's episode, we are joined by Maneesh Taneja to explore a topic every young person thinks about it, but few truly understand: the financial freedom. From managing your first pocket money to building long-term wealth, this episode breaks down how small, consistent habits can create big financial outcomes. If you're a student wondering whether it is too early to think about money or too little to start investing, this conversation will change your perspective. So let's get started. And just to give a brief introduction about uh, Manish and I got to know each other in 2021 as one of the common cohorts of Mr. Amit Verma's writing groups. Very recently, Manish has written his first book, and when he reached out to me, I thought, why not actually, talk to Manish and create a conversation around how we can create a good habit for youngsters in terms of starting early and investing early. So, thank you, Manish, for being with us today, and thanks for uh, sharing your insights.
Thank you, SPG. Thank you for the opportunity. It's lovely to catch up with you. Thank you for your kind words. Look forward to our conversation.
Okay. So, Manish, before we get into the subject, please tell us about yourself, your journey, your professional journey, or
Right. So, SPG, I am a career wealth manager. I started working in the wealth management space in the year 2008. I am currently based in Gurgaon, and I advise ultra net worth, high ultra net worth, and institutional investors as to how they can manage their money. That's what I do on the professional side. Personally, I was brought up in a small town called Bhopal. It's not small anymore. Bhopal, as you are aware, is the capital of Madhya Pradesh. Very interesting city. My parents, both of them were working. So I come from a uh, very standard Indian middle class 80s, 90s background. Both the parents were working. Uh, and Financial health and financial safety was a key uh, part of my upbringing. From a very young age, it was impressed upon me that one must save. The idea just because you have money in your pocket does not mean you have to spend it. uh, there should be some part of your money that you save every month, whether it's your pocket money or whatever money you get from, sometimes when we would come to our Nanihal in Delhi as children, we would be given small cash gifts by relatives. My mother would always impress upon us that just because you have money in your wallet does not mean you have to spend it. So, growing up, the idea that money has to be saved was ever present. It was an important part of growing up. Uh, Money, as you know, makes the world go round. So, yes, I was brought up in Bhopal in a very comfortable middle class service background. And the idea always was that one has to be financially independent. And financial independence is not just how much money you're making, but also how much money you're saving. Since I grew up in 80s and 90s, there wasn't too much focus on investing. I see a lot of youngsters now not only interested in saving, but also interested in investing. But I grew up in a very different time. Yes, so that's a little bit of my professional and personal background. Thank you. You mentioned the book. This is the book. The book's called Seven Steps to Financial Freedom: Simple Habits, Compounded Returns. And before we talk about the book, I would like to tell our audience that all royalties of this book, from the sale of this book, will go to Sakshi's Joy Foundation. Sakshi's Joy Foundation helps underprivileged pediatric oncology patients access treatment at Tata Memorial Cancer Hospital in Mumbai and at RGCI here in Delhi. So children who unfortunately have cancer and their parents cannot afford the treatment, the foundation helps those parents. So all royalties from the sale of 7 Steps to Financial Freedom, Simple Habits, Compounded Returns goes to Sakshi's Joy Foundation.
That's fantastic. So, also tell us about your professional background. I mean, you
Yes,
are
I
somebody.
started my wealth management career while I was employed with Standard Chartered Bank here in Delhi. Then I did a stint with Citibank in their wealth management division. After that, I was a private banker for one of India's leading wealth management outfits called 361. And then I did a stint with the Axis Bank in their Burgundy private practice. In between, I was also associated with a couple of fintechs where I helped set up the mutual fund business. So, हमारे यहाँ SPG, the saying is that for a wealth manager to really know what he or she is doing, they should have seen at least 2 down cycles of equity markets. So when I look back, I've seen the 2008 downturn, I've seen the 2013 crisis, I've seen the 2016 uh, post demonetization upheaval in the equity markets, and I've seen the post COVID crash, and now whatever we've been seeing in the equity market for the last couple of years. So, seen a few market cycles, worked with large organizations, and I've been advising families and institutional investors on how they can navigate these upheavals and help their money achieve their financial goals.
And the primary goal of your advice is to help your clients invest into the right kind of mutual funds and other products. What are the products normally you advise them to invest in?
So, products are sort of a derivative of what is it that the clients want to do with their money. So, you will have clients who will be at various stages in their life. So, there will be clients who will be there in their 30s when they are more right now, they're earning, their larger expenses are still a few years away. So, the kind of portfolios we run for them are very different from the portfolios of, let's say, somebody who's retired and is now looking at a regular income stream from their portfolio to sustain their lifestyle. Then there are clients who really don't need any kind of returns from their money right now. There is enough that is being generated from their businesses. And there, the idea is preservation of wealth that they've accumulated, and then at some point, a successful transition or transmission to the next generation. So, basis, what is it that the clients are doing? What is it that their financial goals are? Which stage of their earning cycles they are in? Uh, uh, I'm sorry. Basis where they are, uh, depends what kind of portfolios we run for them. And once we've decided what is the portfolio that we are running for them, then we come upon what kind of products that go in. So, yes, mutual funds do constitute a large part of the portfolios that I run, but mutual funds are not the only products that we do. We also do regular fixed income products like bonds and fixed deposits. And then there is also an allocation to commodities in the form of ETFs. So yes, mutual funds are a part of what we do for clients, but that's not the only product that goes into the portfolio. It's the design of the portfolio, and it's the financial goals and the needs of the clients that decide what kind of products go in the portfolio.
Fantastic. Now, let's say a 18-year-old boy or a girl watching this conversation with us. So for them, uh, fortunately for many of them, actually, they come with a lot of affluence because of their upbringing now. So to start with, I mean, do they really think that financial freedom is important at the age of 18? So how do you start a conversation with the 18-year-old boy or a girl the about the importance of a financial freedom?
Right. It's interesting you say that. So, a lot of 18-year-olds, especially those who come from affluent backgrounds, where parents have really supported their education and they still have years to go before they join the workforce. There's no pressure to join the workforce. Look at finances very different from somebody in India who may need to be on their feet at 18, 19 and support a family's income. So let's first talk of the first category. If you're an 18-year-old and you've been lucky to have parents who are supporting your education and you still have runway before you join the workforce and have to worry about making money, then I would suggest you focus on acquiring skills. 18 is a great age. We are blessed with the kind of access we have to technology today in India to acquire skills that you think will help you have a very enriching and successful career. It could be learning a programming language, it could be learning a foreign language, it could be acquiring a skill set that you think will help you become the kind of professional you want to be. So, if you're an 18-year-old and if you are lucky to not worry about money, more than financial freedom, I would impress upon you that you look at acquiring skill sets, whether it is learning a new programming language, whether it's learning a new just a language, so that you are exposed to literature, art, and cultures of other parts of the world. Anything that'll help you inculcate a habit that will add to your skill set. So if you're an 18-year-old, maybe it's a good idea to get into inculcating habits and being disciplined about them. And yes, saving the allowance that your family gives you to manage your expenses is a very good habit. I am firmly of the opinion that just because money is in your pocket does not mean you have to spend it. Like I often tell my nephews and nieces who are 16, 17-year olds, uh, you're spending money on something if you'll not even remember that experience, or you'll not even need that thing a couple of weeks down the line, then is that the right place to spend your money? Maybe you can spend money on something else. So if you're an 18-year-old and really don't need to worry about money, then I would suggest that you focus on acquiring skills, building a habit, and sustaining those habits. I can tell you from my experience, I struggle a lot to keep my habits going. It's very easy to get started, but then to be motivated and stay disciplined to stick to those habits. That's where my advice would be that as an 18-year-old. And the principle of compounding, which works in managing money, works in all aspects of life. So if you want to learn an instrument, if that's what will make you happy, if you start at 18 and you practice half an hour every day, by the time you are 24, 25, you'll be far more accomplished and you would have built this beautiful habit and demonstrated discipline in an aspect of your life, which will give you confidence for a lot of aspects of your life. So, if you're an 18-year-old who would like to sort of start running half an hour, start learning an instrument, do anything for half an hour every day, and by the time you're 23, 24, 25, compounding will really kick in. You'll really feel good about that habit. You would have acquired a skill set, and that will give you the confidence to do a lot of things in your life. Now, if you are somebody at 18 who needs to make money and needs to be financially independent as soon as possible, then I would suggest start saving, start investing, and don't stress about and don't worry about, अरे बहुत छोटा amount है, what difference will my life make at the age of 100, 200, matlab, even if I'm saving 100, 200, 500,000 rupees. Please don't look at it that way. Start. Start small, start early, because as you spend more time seeing how that money is growing and saving, not only have you built a habit of saving and investing, you are getting the experience of managing your emotions, and that will give you a lot of confidence going forward.
I mean, the key word here is actually habit.
Absolutely.
And the other keywords you said, not just saving, but also investing.
Right.
So, can we deep down on all these three words actually? I think, in terms of with respect to the money handling part of it, each of them are very, very important at at any stage actually. But then the importance of starting early, and the reason for this is that at 18, youngsters are allowed to vote. They are allowed to
Drive.
uh,
They're allowed to drive.
drive. They are allowed to vote. So they are adult in a way. Of course, many of them actually stay back at home, unlike other European and other Western cultures. But if you have that independence of getting your pocket money, and if you have the independence to decide what to do about that money, then at least start with something. So, so let's deep down a little more about this aspect of habit, saving, and investment.
Right. So first, let's talk about savings. I don't envy 18-year-olds today in one aspect, which is the sheer pressure on them to buy things, and the whole environment around them. There's so much pressure on them to buy that next gadget, to buy that next clothes, buy the next set of clothes, to partake in an experience. There's a lot of pressure around you guys. I totally get that. Uh, and it's if since everybody around you is doing it, uh, there's so much marketing effort that a lot of companies are putting in to make you spend. I totally get the temptation, and I know it's very difficult. but maybe a framework that I discussed earlier also. How about asking yourself that if I buy this, or if I spend money on this experience, will I be needing this? Will I need this a month down the line? And will I remember this experience a month down the line? Anything that is very transient and very temporary, and just because there is a lot of encouragement by the environment around you to spend, maybe you need to ask yourself. Once you've sort of asked yourself, do I really need to spend? Uh, do I remember what did I do with my money 3 months ago? You'll realize the pressure on you. You'll feel confident that no, you don't need to really, really need to spend money on things. Because why am I saying that you should delay your gratification and save? Uh, Money in your pocket, money in your bank account, money in your investment portfolio. As you grow up, you'll realize there's a tremendous source of confidence. You'll be able to take a lot of risks in your life. If you have money in your bank account, then you will always have the confidence of trying something new. Because at the end of the day, money makes the world go round. So if you have money in your bank account and you know that money is always growing, your ability to spend that money on acquiring a skill set which will help you earn more money, your ability to take risks in your life, professional risks in your life, really goes up. And if you start early and start really saving, and if you get into this habit, that let's say, I've given you a framework, now let me give you a number, that every month, whatever money I get from my as my allowance, if I save 10% of that, if I save 10% of that, you'll realize in a couple of years' time, there is money in your bank account, there is money in your investment portfolio that'll give you a confidence that you can only feel. I'm sure SPG will agree. There's nothing like having money in your account, because money is freedom. It'll give you the opportunity to try out a lot of new things. So start small. Say, let's say 10% is what I'll save. So if you build a habit of 10%, not only are you then resisting the temptation of spending on things you'll not even remember a couple of months down the line, you're resisting the peer pressure of spending money. In a few months, the money in the bank account will give you a lot of confidence to do a lot of other things with your life. You'll be able to go uh, backpack to some country on your own, go spend some time in a, you know, learning a musical instrument, visiting an ashram, backpacking, trekking. There are a lot of things that will sort of make you a more enriched individual. That's my experience. I know I am closer to 50 than I am now to 40. But my lived experience is that money in the bank account is a lot of source of a lot of confidence and will, increase the scope of your risk appetite. So build that small habit. It can be 10%, 5%, 15%. So first you ask yourself, do I really need this? Will I remember this experience 2 months down the line? Do I really need this gadget? Do I really need these clothes? Will I be wearing them 6 months down the line? And once you sort of start looking at things like that and that'll give you the confidence of saving. And once you've sort of gotten into the habit of saving any part of your monthly income, then look at investing. What do I mean by investing? It is deploying your money in a way that it generates a suitable return. So your money is not just your 100 rupees in the bank account does not stay 100. It grows to 104, 105, 106, 107. And once you see the magic of markets doing its bit and that 100 becoming 115, 20 over 2 years, 3 years, it'll give you a lot of confidence again. That not only was I able to build this habit of not spending on my impulses, not spending just there, just now, just right now, right here, kharch kar lete hain, party kar lete hain. That money is now grown, and now that because that money is grown, I can partake in something that'll give me a more lasting skill or happiness. So the moment you start looking at your expenses in a way that help you defer your unnecessary, I'm not saying unnecessary expenses, expenses that really don't make you happy. The moment you start getting into a habit of some percentage of money as an experiment, I'll start saving. And once I start saving and start investing those small amounts in some place where it grows, a combination of all this, by the time you are 23, 24-year old, will give you tremendous confidence for doing other things in life. I hope that was helpful.
Yeah. So Manish, let's try to simplify this. So when you say, I think most of the 18-year-old boy or girl today will be able to manage their bank account on the mobile app itself. So can you give some simple methods when you say saving? Obviously, it has to be actually taken out and put into somewhere. So now that somewhere could be, can it be some kind of a RD, some kind of a mutual fund? What are those instruments which a 18-year old boy or a girl can manage from the phone itself?
Very good. That's a great question, sir. So let's build on that. So one of the ways that you can sort of resist the temptation of spending money is if your money is not always in your savings bank account. So because you have UPI on your phone and the money is always in the savings bank account, sometimes you're not able to resist the temptation of spending. So on your banking app, you can also start an FD. Every bank, if you have surplus money in your bank account, gives you an option of doing a fixed deposit. So some part of money, whatever it can be, 5%, 10%, 15%, the day you get that money, if you put it in a small deposit, you can do as a deposit. It can be a 6 months deposit, 12-month deposit, 15-month deposit. Because once it is in a deposit, it's not instantly available to be spent through a UPI app. Even if you have to break the deposit, it'll take time. So it'll give you a pause and you'll be able to think, do I really need to spend? The other thing you can do is India has this lovely product called mutual funds. And our mutual funds are not always equity mutual funds. You can also do what we call debt mutual funds, where your money is invested in bonds and fixed income instruments, and it gives you a slightly higher rate of return than savings bank account. So you could download an app. As an 18-year-old, you can invest in mutual funds. You could start by investing in money market mutual funds, liquid funds. These are debt mutual funds which will give you a slightly higher return your savings bank account and will again solve your purpose of taking money off the UPI app. So once the money is invested in a money market fund or a liquid fund, you'll not be able to instantly spend it. You'll have to wait for it to come to your bank account, and that will take one working day. So if on a Friday evening you are tempted to spend with your friends, but you have to redeem money from your mutual fund account, the money will not come to your bank account before Tuesday, because the money will only now get redeemed on Monday. So these are small things that can help you defer your expenses. So once you have an app, all your banking apps will give you an opportunity to book a deposit or do debt mutual funds. Now, this is a very good way of not only deferring your expenses, but also earning slightly more than your savings bank account. Now, if you've got the appetite and if you've got an interest, inclination, that what are the other options, what are the other opportunities that I have where I can earn a lot more than what my savings bank account does, then you can explore other kind of mutual funds, which are equity or multi-asset mutual funds. But there, I would suggest that you spend some time with a professional. You understand from them what are the risks involved, what are the returns that you can expect. A more comprehensive discussion is needed because those are the products where you actually there is a meaningful risk of your principal eroding. So you don't want to be in a situation that as an 18-year-old, 19-year-old, you've started investing and in 6 months' time, your 10,000 rupees is now showing as a value of 9,500, which is very much possible in 6 months' time. Over a long term, historically, we've seen markets give good returns. But before you start investing in non-fixed income instruments like equity mutual funds or ETFs or any kind of commodity product, I would suggest take out time, reach out to a financial advisor. You can connect with SP sir. I'll be happy to help you. But have a more informed discussion before you move on to more high yielding and high risk products. But a good way to start, if you are an 18, 19-year-old and you are worried about नहीं UPI से savings account से कभी भी पैसा निकल जाता है, do a short-term deposit with a bank or do a liquid fund or a money market mutual fund. Not only will it earn you a slightly higher return than your savings bank account, it'll also help you defer your spend.
Fantastic. Now let's try and understand about compounding, because that's one key word which you have used in your book also on the cover page as well. So can you explain about what compounding is in simple language? Of course, we all have learned about compounding in school maths, but can you explain with respect to a live example?
Yeah, absolutely. So compounding is God's gift to mankind. Everything that we do, if we do it regularly, अगर हम उसकी एक हैबिट बनाएं, if we build a habit, if you're an 18-year-old, there's a good chance you read, there's a good chance you play some sport. Now ask yourself, what was your reading speed 4 or 5 years ago, or if you are into cricket or tennis or basketball, your proficiency 4 years ago and what the proficiency level is today. And the difference between what you could do 4 years ago, and if you've done it regularly over the last 4 years, and what you are able to do today, that is the power of compounding. So when we do the same thing again and again and again and again over a period of time, the effort accumulates and the results are far more than what they would be if our effort was disjointed. सिंपल हिसाब है, अगर मेरे को डिस्टेंस रनिंग करनी है, मैं हफ्ते में 5 बार दौड़ता हूँ सुबह उठ के, और मैं हफ्ते में 1 बार दौड़ता हूँ सुबह उठ के. If I get up and run 5 times a week or I run only once, my progress over 4 years will be materially different. A friend who's running 5 times a week after 4 years will be able to cover a far larger distance at a better speed than me if I run only once a week. That very simply is what compounding is. If you do same thing again and again and again, then over a period of time, it all adds up and the final result is far more than what it would be if the effort was disjointed. How does it work in money? Simple maths. It's what we've all learned in school. Let's say my investment is giving a return of 12%. It's a very good return. It's a fantastic return. I'll tell you something very simple. I'll tell you today the rule of 72. What does the rule of 72 say? It says if I divide 72 by the portfolio return, which is 12% in this case, I get 6. So, mota moti, broadly, my money doubles every 6 years. So, if I have 100 rupees and I am getting a 12% return on my portfolio and I am 18, by the time I am 24, this 100 will become 200. How much will it be when I am 30? It'll become 400 because it's doubling every 6 years. How much will it be when I am 36? It'll become 800. How much is it when I am 42? It'll become 1600. So, every 6 years when my money doubles, at the end of 30 years, I'm looking at a far bigger sum than 100 becoming 200, becoming 300, becoming 400, becoming 500. So, when you are young, in any endeavor, if you start putting in the effort, and in this case, we are talking investments, if you start putting in that effort and if you start investing and you're able to deliver a 12% return on your portfolio, by the time you are 30, 35, 40, 45, it'll be a very meaningful sum. And that applies to all aspects of our life. So one of the reasons we say start early when it comes to saving money, because then you have a long runway where your money is compounding. Essentially, that's what's happened. So if you ask your parents, which is the one investment that they're most proud of, there's a very good chance they'll tell you about their house or some property investment that they did. Now, the reason it's such a good investment is because they've retained it over 20, 25, 30 years and that money has compounded. That's what we mean by compounding. So you do the same thing over and over again. You don't take a break. You don't stop. So you don't stop after 6 years. Oh, my money's become 100 to 200. I'll stop. Because then if you take out that 200, then you have to start the clock again. But if that 200 stays invested, then it becomes 400, 800, 1600. So the beauty of compounding is that it all adds up. You are beneficiaries of that compounding. Ask yourself, how good were you at a skill 4 years ago? Any skill, reading, writing, playing a sport, playing a musical instrument, your mathematics, whatever. You are far better at it now than you were 4 years ago, purely because you've been at it for 4 years. So if you stay invested for a long period of time, your portfolio will also benefit from that. That's what we mean by compounding, and that's truly God's gift to mankind.
Okay, so let's say somebody starts investing, but is there some way that we can actually automate the investment process so that we actually take out the inconsistency part? I mean, there's a problem that you can start a process of investing or doing anything. You talked about skill development, you talked about learning something new language, and so on and so forth. So, especially for the investment part of it, um, is it possible that they can actually automate it so that the doubt or the inconsistency in the process is addressed?
Absolutely. And SPG, that's also a very good way of building a habit. So, there is an old saying, right? Motivation gets you started, discipline keeps you going. So, today, if you want to do a monthly recurring deposit, आपने mentioned क्या recurring deposit. What is a recurring deposit? The word recurring is regular. So, every month you can put a standing instruction on your bank account and you can tell the bank that on the 5th of every month or whatever date you decide, please take this much money out of my bank account and put it in a deposit. Create a fixed deposit for me. You can do this in mutual funds also. You can do it in any way. So you can say, you can tell your father or you can do it. You're an 18-year-old, you have access to a banking app. You can create this habit of investing on a day every month. Just tell your bank, whatever is every 5th of the month, please take 1,000, 1,500, 2,000, whatever is the amount from my bank account and create a fixed deposit. Not only have you now saved, and you can create a standing instruction. Today, tech enables you to create a standing instruction. हम सब नेटफ्लिक्स का सब्सक्रिप्शन, OTTs का सब्सक्रिप्शन अब UPI से स्टैंडिंग इंस्ट्रक्शन के थ्रू करते हैं, उसे ऑटो डेबिट कहते हैं, राइट? सो देयर इज एन ऑटो डेबिट ऑन आवर अकाउंट एंड द मनी गेट्स पेड. You can do an auto debit on your account on a given date and invest your money. It's a great way of building habit. The moment the money is not in your account, now the temptation to spend is, now it's difficult to spend. And the moment something is difficult to spend, it's giving you a pause, it's giving you a moment to think, do you really need to spend? So yes, I think that's a great way of building a habit. And yes, tech enables you to put something we call as an auto debit or a standing instruction in your account to save money every month.
Okay, you mentioned about percentage. Say you can start with 5% or 10% or 15%. Um, so, is there a way that we can actually say that, okay, if let's say uh, 5,000 rupees is the pocket money for somebody
Right.
every month, what would be a ideal saving to start with? If somebody is starting today, what could be an ideal scenario in terms of starting? What minimum amount is something one should look at out of 5,000 rupees?
So it's a very personal thing, but if you're starting, I would suggest you start at least with 1,000 rupees, and I'll tell you why. Because at the end of the year, if you save 1,000 rupees a month, you will have a sum which will look meaningful to you. You can start with 100, 200, 300 also, and there's nothing wrong in it. There's nothing wrong in building a habit of starting. But not only is 1,000, which is almost 20% of your monthly allowance, a reasonable sacrifice, so you'll take that habit seriously. At the end of the year, you'll have a corpus in your bank account which will seem meaningful to you. So I would suggest you start with a 20% and then take it from there. The key to really savings that, I look back as an 18-year-old myself, is the ability to resist the temptation to spend. So if you're able to resist the temptation to spend, and it's not easy, I'm totally with you. It's not easy at my age. I am tempted often. It's we are all around us. The world is nudging us to spend. It's always nudging us to spend. But what's really helped me, and I've spoken to some children of my cousins and everybody, a lot of 17, 18-year-olds, and which is where this framework really comes from. Do I need this? Will I remember this experience 2 months down the line? 2 months down the line, if I don't need this, if I'll not wear it 6 months down the line, 8 months down the line, um, then do I really need it? Then do I really need to spend on it? How about I save it and then a year down the line, I buy something more interesting or spend that money on a more interesting experience?
I think that's a very fantastic framework in terms of asking the question whether you need something when you're buying something. It's a great framework to pause and ask the question whether you really need it, and are you going to remembering it, let's say in a month's time or 2 months time or 6 months time.
Yeah,
And that's a fantastic framework.
yeah. And the money saved is you can. It's not. We are not saying don't spend it. Maybe spend it on something more meaningful. Let's say you're saving 1,000 rupees a month instead of spending it on a Friday evening having ice creams and whatever. I don't know what you spend on. But in a year's time, you have 12,000 rupees, and now you can buy a more expensive book. Spend it on a gym instructor, spend that money on learning a musical instrument or online classes for learning Mandarin. Food for thought.
Fantastic. Yeah, fantastic. Okay, now Manish, I know the book which you have written is primarily targeted towards slightly adult people who are, let's say, in their mid 25, 20s or 30s. But then there are some interesting chapters which the 18-year-old boy or girl can also actually read and very easily understand. It's a very nicely written book with lovely graphics and lot of the information table which I have seen myself. So can you explain about some of the key chapters
Right.
which the 18-year-old boy or girl can actually read and understand the concepts far better?
Right. So the book is SPG 7 chapters. So you basically start on a Monday and you can finish it on a Sunday. The first 4 chapters I have borrowed from basics of portfolio management. The first chapter talks about risk. The second chapter talks about diversification, which is a age-old, time-tested tool for managing risk. Then the third chapter talks about discipline of asset allocation. The fourth chapter talks about power of compounding. And then I've written 3 chapters on my lived experience, which is basically save for a rainy day, get a good financial advisor, and then spend within your means. So I think we've spoken enough about spending within our means. Let's talk about the first 4 chapters. So basically, I first talk about risk. S- you, so life's basically we are all risk takers in our life. The fact that if you are watching this podcast or listening to this podcast, you've taken the risk of your time. You've sort of assumed that this podcast, this conversation is meaningful and will add value to you instead of reading a book or spending time with your friends. So all decision making is essentially a risk return trade off. We are basically asking ourselves if the time and money that we are investing in something, will it give the commensurate return? Will it give the return that is worth our effort or worth our money? So uh, please be confident. You're all risk takers. If you're listening to this, you are a risk taker. Uh, and without taking risks, you can't move ahead in life. It's very status quo is very comfortable. It's okay to put money in savings account or put money in an FD. Now I'm talking slightly more, for a higher investment return. But at the end of the day, if you don't take some amount of risk in your portfolio, uh, it'll be very difficult for your money to grow in real terms. What do I mean by real terms? Inflation adjusted terms. So please be confident. You are a risk taker. Your risk management works. You've taken a lot of risks, and it's okay to take some risks when it comes to your investments and investing in financial assets. Now, once you've taken that risk, that's when we come to the second chapter, which is basically diversification. Now, diversification is again a tool you're all very familiar with. Simple example, if we are traveling in public transport, if we are taking a train or a bus, we don't keep all our money in one pocket. We keep some money in another pocket. God forbid if the pocket gets picked, at least not all our money is gone. We all do that. So we understand diversification, which is basically not putting all your eggs in one basket. You can do that in your financial portfolio also. Now, once you've taken the risk and you've diversified, if you really want the returns to come, then you need to follow something called as a discipline of asset allocation. You need to be very confident and you need to be very disciplined in terms of what is your allocation across various asset classes, which is where I'll urge all our readers, all our listeners and viewers to please pick up the book. Uh, I've tried to really break down the discipline of asset allocation in very easily understood terms. So once you've displayed or had the discipline of asset allocation, that's what will help you benefit from power of compounding. We've just spoken of power of compounding. If you really stay invested for the long term, and even if your money grows at 10%, 11%, 12%, by the way, 12% to my mind is a very good return. If your money grows at 12% over 25, 30 years, it'll be a very meaningful sum of money. And we've all seen benefits of compounding. Real estate is something that we are all very familiar with in India. We've all seen वो कहते हैं why is it that the house that Dadaji built is now so expensive? Essentially, what's happened is Dadaji built it in 1975, so it's been around for 50 years. So even if it's grown at a 12%, the money is compounded at 12% for 50 years, and that's why the house is now so expensive. Uh, but the discipline of asset allocation will help you benefit from compounding. Uh, you again, these are frameworks, these are ideas that we are all very familiar with. We just need to sort of apply them when it comes to managing our money. Then I talk about the idea of saving for a rainy day. Uh, World is what it is. We don't know. I mean, December 2019 SPG, if I told you in 3 months the world will be shut down, uh, I would have laughed, you would have laughed, right? We really don't know what's going to happen 6, 8 months down the line. And we've all had instances in our personal life जहाँ पर unexpected events have played out. So it's always nice to have some money in the bank account. Don't invest it, just keep it in a bank account, save for a rainy day. So I talk about low probability, high impact events. Um, so an aircraft crashing is a very low probability impact event, but it's a very disproportionate impact. So one should always have some money in the bank account for a very low probability, high impact eventuality. Get a financial advisor. Uh, Personally, I have benefited from advice in other aspects of my life. I've really, gods are kind, I've not needed financial advice. But when it comes to my health, when it comes to my mental health, physical health, my career moves, I've always benefited from a professional giving me unbiased advice. And finally, uh, spend within your means, don't borrow. So these are some portfolio lessons and life lessons that help me manage my money and life better, and I've helped my clients. So these are the 7 chapters I talk about in the book.
Okay, Manish, you talked about 12% return, but at the same time, if we look at historically, the inflation rate by and large in India has been in the range of about 5-6%
Right.
over the years.
Right. So long-term inflation number you can look at 6-7%. So going forward, I also see inflation between 5 to 7%. So if I'm able to in an inflation
Okay.
environment of 5-7%, if I'm able to generate 12%, I think that's a brilliant return. That's a great return.
So we are looking at net return of about 6-7%
Real return of
minus
yeah,
the
real
tax.
yes, yeah, that's real return. Yes, we are looking at a if I can deliver a 5-6% real return and compound it over a period of time. See, what we miss out is what
Hmm.
we a lot of times, and this is a great question, SPG. Ki I know where we're coming from is that 5-6% लगता नहीं है कुछ है. But
Hmm.
reality is even to generate a 5-6% real return is a lot of work. And if you're able to then compound that real return, then you've created a meaningful corpus for yourself. It can be done. People have done it historically. People will continue to do it with the right framework and with the right decision making. Uh, Please don't discount a 5-6% real return. If we are able to deliver a 11-12% nominal return before inflation and compound it over a period of time, you will have a material and a meaningful impact on your portfolios.
Fantastic. No, I totally get that because I know that in traditional business, for example, let's say trading or retailing, for example, in those kind of businesses, the returns are only 2-3% actually, the real return after taxes. After I mean, the net return is about 2-3% in traditional businesses, unless you are into some other IT or other unrelated or uh, the future businesses. But most of the businesses in traditional sense are actually in the range of 2-3%. So which means that if you're able to get a 5-6% of real return over a period of time, that's a hell lot of money. That's like getting double the amount of what you would have got otherwise in the traditional business.
Yes.
Am I right in understanding that?
No, there is a tremendous competitive intensity when it comes to business. देखिए कोई भी business चलाना, and this is where we have to be cognizant of what I call a selection bias. We look at the most popular sweet shop in the city and we think, oh man, this guy is making so much money. What we don't see is the 99 sweet shops that never succeeded. So to look at one successful business and assume that every business gives disproportionate returns of 15, 20, 25%, and we can all expect those kind of returns from portfolios or from businesses, I think is a little unfair. Uh, there is tremendous competitive intensity in businesses, and that intensity translates into very low margins. And also, please realize there is a lot of risk. Any business, even if it's generating you a 5, 7, 10% return every year, there is no guarantee that return will come. There is no guarantee every year it will come. Uh, so I get your broader point that if we are able to generate a real return of 5-6%, which is a nominal return of let's say 10-12%, it's a very healthy return. We should not get carried away by recency bias, what the markets have given in the last 2, 3, 4, 5 years. Uh, we are a fast growing economy, and 10-12% is a very healthy return. The challenge and the opportunity is, can we compound it? So if you're able to compound your money at the rate of 10, 11, 12%, um, I think you would have done a very good job with your portfolio. And yes, your broader point, SPG, that businesses are low margin, high risk, serious competitive intensity, I'm totally with you. We tend to get carried away by that one successful shop, one successful business. There used to be a joke when I was in my 30s that we'll all retire in our mid 40s and start a cafe in our hill station. I can assure you, for every successful hill station for every successful cafe in a hill station, there are a lot of cafes that didn't work out and caused a lot of pain.
Fantastic. No, that's a great way to normalize the expectations from everyone, not just the youngsters, from everyone,
It's not. I
any
wouldn't say
investor.
normalize expectation. It's my lived experience. It's our lived experience.
No, no.
Uh,
Yeah, it is. I mean,
it's
my
painting a more
estimate,
realistic picture.
the figure of 2-3% I said because I come from a professional background for 23 plus years, so I've seen the business from the other side as a business, as a professional managing business owners on the other side of the table, and I know for sure that the real return for them has been in the range of 2-3% actually. So that's my lived experience. So
Absolutely,
I'm
absolutely. No, I'm
telling.
totally with you. Totally with you.
Yeah, yeah. Great. So Manish, if somebody wants to, I hope some of them are actually watching us till this and want to reach out to you. How do they do that?
You can write to me at manish.taneja, Maneesh, Manish.taneja@gmail.com. Uh, Happy
Okay,
to answer all questions and everything. You can also follow the Instagram handle of 7 Steps to Financial Freedom. There is a QR code at the end of it.
sure. I will share that in the show notes also.
Please feel free to get in touch with me. Uh, Happy to help in any way.
Fantastic. So Manish, thank you so much. You really unpacked everything so in simple terms to understand. And I really hope that we are able to inspire some of the youngsters from today to start investing. Thank you
And
for your time.
thank you, SPG. And if you're an 18-year-old, this is the time. Take risks, learn new things, try out new things, whether it's investing or whether it's acquiring a new skill set or building your own business. Uh, Wishing you all the very best. And thank you, SPG. Thank you for having me.
Thank you so much. Thank you.
Hope you enjoyed this episode. We sincerely wish you could take something from our conversation today and be able to apply it to your life in a positive way. We value your feedback. This can help us improve our future episodes. So share your thoughts to serve you better. If you want us to focus on a topic which you think is of importance, let us know. We will share our expertise in future episodes. So, see you soon with a new topic and help you in your career journey.